With this, let's move on and let's also welcome Herald Van Der Linde, who is the head of Asia Pacific Equity Strategies at HSBC. Hi, very good morning and thank you so much for your time. First up, help us with the sentiment that is boding for the emerging markets specifically, because of late we have seen that the whole discussion with respect to the Trump tariff and the worries around that seems to be abating a bit. But do you believe that the investors are once again considering the emerging markets in a deep sense, and how is India placed overall?
Okay, well, thanks for having me on. Yes, clearly there seemed to be some interest in emerging markets. Actually, I think that was already rising to a certain extent prior to the announcements of the tariffs in the last 2 weeks or so. So there was interest in emerging markets rising. That's to a certain extent because the growth outlook was starting to get better. China, to a certain extent, India was a bit of an outlier actually, but China and some of the other countries looked like things were starting to improve in those economies, and the earnings growth was improving as well. Of course, since then, a lot of things have changed. Tariffs have been imposed, as of course you all know so very well. And that has changed the rules of the games to a certain extent. We now see a weaker dollar that is generally positive for emerging markets. We see that outflows from the US, and they have to go somewhere in the rest of the world. And if you're a market that is largely domestically oriented, so not so much exposed to trade, and you have a stock market that has already actually come off from where valuations look a little bit more reasonable than they were a year ago. Now then, of course, these things start to look quite interesting. So emerging markets interest comes a little bit back, but India within that looks actually pretty okay at the moment.
Okay, Mr. Herald, thanks for joining us morning, and also share with us your view on how much do you believe the Indian domestic growth story is insulated from the tariffs, because given other emerging markets in Asia, case in point being South Korea, Taiwan, Japan, Vietnam, we are largely sheltered compared to all of these emerging markets from Trump's tariffs. Now we understand that you are largely neutral on India. Given that we are so sheltered from the tariffs, what are the triggers that could move your view from neutral to positive on India?
Yeah. So the tariffs mean there's going to be less trade around the world. We've seen already economists, our own global economists as well, they've reduced the size of the pie. The economies are not growing as fast anymore. So in that sense, this is a negative for everybody. But the ones that are more exposed, of course, the ones that export in particular a lot to the US. And as you rightly point out, Korea, Taiwan, Japan have much bigger exposure. And not only in their economies, but in their stock markets as well. In particular, Taiwan is very much exposed to selling products in, for example, the US. The markets where this is much less so the case, where in the stock market, the domestic economy is very well represented and is a larger driver of overall earnings, is of course China, Indonesia, and India. And those markets are therefore a little bit more defensive. Now, what we've seen in India, of course, is that growth is actually slowing so far, actually, through the result season. It's so far the guidance has been a little bit better than I would have anticipated. But let's see what happens. But growth is slowing. But still, the feeling is that structurally growth in India over the next couple of years should be okay. As maybe earnings growth somewhere between the 10 to 15% or so. And in the current kind of global environment, that doesn't look too bad. What do we need to see really to get more positive? Now, we actually were quite cautious on India 12 months ago. Not so long ago, we said, listen, let's be neutral because we think that's a little bit more balanced, because a lot of the things that we were worried about to a certain extent had already been priced in by the market or had faded. You have, for example, valuations lower. The realization that the earnings growth is not going to be as fantastic as it were over the last 3 years is now well priced into the market. Also, that you have some policy support that can come through that can be good for the market. So in that sense, India starts to look a little bit better from here on.
All right, but any sectors that you wish to flag off? Because what we have seen is some of those segments which have the high ownership of the FII specifically, those are doing well when it comes to the Indian markets. And of late, the valuations have also seen to reset themselves for a bit. Help us understand that sectorally, how do you see the picture shaping up for the Indian markets, as well as where is your interest boarding up well?
Um, the sectors that we talk about with mostly foreign investors is to a large extent large liquid sectors where valuations are reasonable. So you end up with the banks very often, private banks in particular, or where valuations are maybe a little bit more elevated, but where at least the growth story is relatively macro insensitive in the sense that, for example, is dependent on demographic or slow shifts in society that even though interest rates go up or down, don't really change that much. Think about, for example, rising consumption or, for example, demand for medical and healthcare in India, such as hospitals and these sort of things. So those are the sectors where we look at as well. So bank, consumer, and I would say selected but domestic healthcare.
Okay, also, Mr. Herald, help us understand this dislocation on the ASEAN markets. Is it market driven, is it macro driven, or is it a confluence of both of these factors?
I think the dislocation we see in markets is, of course, to a large extent driven by the uncertainties that we now have related to policy making, not only in the US, but in other places as well. It's a highly uncertain sort of environment, and it makes it very difficult for companies to make investments. If you're going to put investment somewhere in the world, where are you going to put it now? And does it mean if you think, well, the tariff is going to be imposed X and Y, for example, you want to be in the US or Mexico. If you're going to go to the US, but the tariffs will be reduced, then you should have gone to Mexico. But if you go to Mexico and the tariffs are not going to be reduced, you should have been in the US. So it's that uncertainty to investments primarily by firms that is really leading to a sort of dislocation in markets.
But Herald, what we understand is that your view on the China market still remains bullish, and you are still liking, given all that tariff uncertainty around and the kind of tariff war that US and China are having at this point in time. How do you justify that?
I think, first of all, stock markets are not the economy. That's very important. And it's particularly in Asia the case. So although there will be an impact on the overall economy, I think the impact on the overall stock market in terms of earnings is not going to be so high. Of course, there's uncertainty related and the growth is going to slow. That means that earnings will have to come down. But the vast majority of the earnings generated in the Chinese stock market are simply coming from domestic. I mean, it's larger telecom internet companies and delivery companies and banks and insurance and these sort of things, consumer companies. That's all generated domestically. They will be impacted, but not as much. Secondly, China has had to deal with a lot of problems over the last couple of years, and they are a long way through resolving that. We see signs that things are improving, for example, in the property market. We see consolidation in many industries taking place as well, which is a positive for profitability. We see that some sense of confidence was starting to come back. We're going to see how that now unfolds, but before the tariff announcements, some sense of confidence was coming back again. And we've seen quite heavy buying by mainland Chinese through what we call the southbound channel from, say, Shanghai, people in China buying in Hong Kong. That has been quite a lot of money. China is cashed up. It has a lot of cash. Most households have not bought property or stocks over the last couple of years, and therefore they're cashed up. They have some money to spend. So it's these sort of things that make us believe that the outlook for Chinese equities remains pretty okay in the relative kind of environment, right? The whole world is down. India has actually done very, very, very well, but it should be able to digest all of this.
But Herald, does that mean that you're building a bull case, or you're expecting a good run-up in the commodities as well, given the fact that China is one of the biggest consumers and producers of the base commodities specifically?
Yeah, but I think the sort of nature of recovery in China is not going to be as metal intensive. People are not going to buy houses. but they're going to travel. So it means you don't need the stainless steel to buy the houses, but maybe demand for gold or platinum and these sort of things might so that's jewelry amongst others that might improve a little bit. I think within the metal space, what is more important is actually to look at industry rationalization, where supply is a little bit tighter. And we see this, for example, in sectors such as platinum. So that's a sort of metal that we would prefer. So I think the nature of the demand recovery in China is going to be much more on services and less on sort of the investment in real estate that we've seen in the past. And therefore, the spillover effects into the metal market is going to be quite different this time around as well than it did 10 years ago.
Okay, Harold, point taken. And also, I couldn't help but notice you're rather bullish when it comes to Indonesia. It's also a part of your deep value market, as well as you've maintained an overweight on Indonesia. Help us understand what could be the factors behind this. Is it on the back of cheap labor? Is it on the back of the formalization of retail, which seems to be a strong headwind, or tailwind rather, for that economy? Or is it on the back of the palm production? Because multiple factors are coming to play when it comes to Indonesia. It's been a strong emerging market as well. So what's your take on that?
Yeah, Indonesia has got a lot of themes that are very, very similar to what you see in India. So the rise, for example, of formal retail, banking growth in the banking sector because of deeper financial markets, people basically opening up bank accounts and these sort of things, or making for the first time use of credit facilities that in the past they didn't have access to. So a lot of the longer term themes that play around in Indonesia do play in India as well. Actually, I think there will be some lessons from Indonesia that could be quite interesting for India in the future as well. But the reason why we like Indonesia at the moment is that that market has already been very weak. It is incredibly cheap. It's one of the cheapest markets on a relative basis to the rest of Asia. And we haven't seen the discount of Indonesian equities being so deep as it is at the moment. And that's because of a lot of uncertainties to fiscal policies and a new government that has come in and these sort of things. I think that will change now. They will do more in the fiscal side, try to improve growth in the second half of this year. And therefore, that market looks pretty attractive. And what we've also seen is a lot of people have been selling Indonesia in the past. So the actual exposure they have to that market is not very much, is not a stretch. Unlike, for example, Taiwan, where a lot of people still heavily overweight. So that's something that market needs to digest.
And Harold, what are some macro insensitive growth themes that you are spotting in Asia and especially in India that could keep the Asian markets largely sheltered from everything that's been happening in terms of global volatility and macro uncertainty? What are some themes that you are spotting, and where do you believe India stands in the middle of all of this?
Yeah, I think there's actually quite some interesting themes, in particular in Asia unfolding, that are really insensitive to macro. So think about aging, for example. Older people consume differently than younger people. And unfortunately, however it is, and unfortunately you as well, we all get older over time, irrespective of what happens with the economies. And therefore, our spending patterns will change as well. So aging is important. Healthcare fits into that. We know that the world is spending more on defense. So that's an important sort of thing as well. The Europeans will have big ideas and projects to beef up their defenses. That will spill over into India, but also markets like Korea or Taiwan over time. And of course, as I mentioned earlier on, you have the rise of formal retail in large parts of Asia. That's in India, but Indonesia as well, or shifts in that formal retail, and that's related again to aging. For example, in North Asia, we see that more and more households are single-person households. So they consume differently. If you live on your own, then you're not going to cook an elaborate meal, but you're going to go for ready-made meals, or you're going to go to a restaurant very quickly instead of cooking something at home. So those are sort of consumer trends that, whatever happens with tariffs, interest rates, currencies, these things will continue to go on, and it gives a sense of certainty in these days.
All right, but Herald, though for the Indian markets, the benchmarks are doing very well, the broader markets are still yet to participate in the rally. But the key to note is that the valuation discomfort for the Indian markets did persist even before this correction actually started. Help us understand, are you spotting any risk factors that which maybe the Indian investors specifically are ignoring at this point in time?
I mean, the risk factor, I think, really lies on growth. India growth is slowing. We know that. It doesn't have the high growth that it had over the last 3 years of 20-25%. The question is, at what sort of growth are we going to settle? The feeling is it should probably somewhere around maybe 15% over time. But what we've seen, that some of the numbers that came out late last year and early this year show that that's really tracking well below that single-digit sort of growth. So this upcoming results season is going to be quite important to see, what sort of growth are we going to have? Because if you have a market that grows at 15 times, 15%, then we'll get a higher multiple than the market that grows at 5%. So it's that sort of thing that we need to look at. What is the growth that India can generate in the next, say, 24 months or something like that? So that's what we're looking at. We're very anxious to see how the reporting season is going to kind of shape up in India.
Amidst the result season itself, we have the numbers coming in from some of these IT majors, Herald. What the outlook does suggest is a bit of an uncertain times, as the companies are highlighting that for now the picture is not that clear and the earnings were not that great, but investors are finding comfort in the valuation. So any view on the IT at this point in time?
Yeah, no, I mean, what the IT companies have said, I suspect most companies around the world are going to say. They are not quite sure what the tariff implications are, what is happening with trade, and what the second round effects of sort of a slowdown are going to be around the world. So everybody is freezing up, and that in itself means that there's going to be not only less trade, but probably less investment as well. And that creates to that uncertainty. And not all of that is fully reflected in markets. But yeah, the good thing is, if this would have happened a year ago, India was over-owned and extremely expensive. But the valuations have actually come down quite a lot, so that is supportive to India. And a lot of foreigners have already been selling India over the last almost 2 years now. So the positioning data, the sentiment, and the valuations, in that sense, look a little bit better in India now than they did 12 months ago. And that makes India look relatively better than some of the other markets.
Okay, Herald, on that note, we'll let you go. Thanks once again for joining us bright and early this morning and sharing your view on the Asian markets as well as how you see India placed. Before we move